And we are live. It is January 15th, 2024. And we're going to start this reading at chapter 13, which is page 137 in the book. Okay. Let's do that. Okay, so chapter 13. Oops, they got ya. We feel there has been enough information given in Volume 1 to understand court cases and these revenue rulings. Before we get into the revenue rulings, we share with you this recent appeal. While the revenue ruling applied to simple trusts with one beneficiary, this offshore court case demonstrates using several trusts inappropriately to hide money. Where is the beneficiary? Because we emphasize so much in Volume 1 the importance of a legitimate beneficiary, we share with you this short summary of a tax evasion case using offshore trusts. We feel this overview is sufficient so you can now know what not to do. Okay, so here it is. Before Easterbrook Chief Judge and Wood and Evans Circuit Judges. Easterbrook Chief Judge. Denny Patridge, who owned an insurance agency, decided to make life hard for the revenuers by transferring his income to an offshore trust and then pretending that he had no income. The first trust in line, located in Antigua, transferred everything to a second trust in Belize. The second trust transferred the money to a third trust, also in Belize, which loaned it back to Patridge, who conveniently never paid interest or repaid any of the debt. When applying for credit, Patridge treated the proceeds from Trust 3 as income and claimed to have no debts. Trust 1 and Trust 2 filed tax returns, each claiming to have expenses exactly equal to its income. Trust 3 never filed a tax return. Patridge himself filed returns in some years, though not in others, and claimed to have ineligible income. After an audit, the IRS concluded that Patridge's income was significant and that he owed $74,279 in taxes for 1996. And $49,836 for 1997. Penalties took the total to $130,736 plus interest for 1996 and $88,675 plus interest for 1997. Mr. Patridge lost. The judges declared his argument frivolous, using 10 pages to express their total disapproval of methods and procedures. They discussed tax law in brief. This situation was so outrageous, the judges considered sanctions. And the footnote on that is just referring to the case, United States of America versus Denny R. Patridge. So, when is a grantor taxable? IRS personnel decide when an irrevocable trust is used as a grantor trust by how external documents are filed. For example, under whose name is the property recorded at the county recorder's office? Does the grantor have enough cash flow to pay the mortgage? In a scam trust, the grantor often shows no income, yet pays the mortgage. Once there is a suspicion of misuse, the IRS launches an investigation. By sending out a letter of inquiry, the IRS tests to see if there is an adverse trustee. The response to the letter alerts the IRS about the knowledge of the trustee. If answered by the grantor, this begins an inquiry. If the trustee gives too much information, showing a sign of ignorance or weakness, then there will be follow-up. There can be follow-up anyways, just because the agent is misinformed concerning privacy and trust structuring. Often, there is little to no training of IRS agents. They harass due to their own ignorance of not only the Internal Revenue Code, but the Bill of Rights. It is essential that a real board of trustees functions. In one of the cases below, the grantor became the trustee. Documents prove that he did not manage the estate for his own gain. We feel that when the grantor becomes the trustee, a red flag goes up, and the grantor is then subject to inquiry. After the trust has performed independently for at least 3 years, preferably 5, and the grantor has enough training to handle the IRS, then the grantor could become a trustee. Reformatting from the original IRS text downloaded from the internet. The wording of the following 3 case studies has not changed. All right. Revenue Ruling 75-257, 1975-2CB, 251, Section 91. Gross income defined, Section 671, Section 672, 674, 676, and 677. Quote, family estate, unquote. Trust. Grantor as owner. An individual grantor who transferred his personal residence, rental property, and income producing securities to a so-called, quote, family estate, unquote, trust in exchange for all the, quote, units of beneficial interest, unquote, therein with himself, his spouse, and a third party as trustees, is considered the owner of the trust under either Section 674, 676, or 677 of the Code. Assignment of his, quote, lifetime services, unquote, to the trust, which included all remuneration earned by him regardless of its source, is ineffective to shift his tax burden to the trust. Full text. Revenue Ruling 75-257. Oh my God, guys, I don't know why I'm all of a sudden getting attacked with yawns. Advice has been requested concerning the federal income tax treatment with respect to the transfer of an individual's property and, quote unquote, lifetime services to the trust arrangement described below. In 1974, C, as grantor, created a trust that he named, quote, the C Family Estate, a trust, unquote, and referred to it as a pure trust, quote unquote, and equity trust, quote unquote, or constitutional trust, quote unquote, hereinafter referred to as the family estate. C transferred to the trust certain property consisting of his personal residence, an apartment building, and income-producing securities. In addition, by affidavit, C assigned to the family estate the exclusive use of his lifetime services, including all remuneration earned by him regardless of its source. In exchange, C received certificates representing all the, quote, units of beneficial interest, unquote, in the family estate under the terms of the governing instrument. At the time of the assignment of his, quote, lifetime services, unquote, to the family estate, C was employed by the X corporation. C notified the corporation of the assignment of his services to the family estate and requested that such sums of money and any other forms of remuneration that would, but for the assignment, be due and payable to him be made payable to the family estate. However, X Corporation refused to comply with C's request and continued to remit to C in his own name C's weekly salary check. C, in turn, endorsed the check and deposited it into the family estate's bank account. C, his wife, and a third party were the designated trustees of the family estate. The trust instrument provided that a majority vote is necessary for any action to be taken by the family estate. As trustees, they are given a broad grant of powers. They may do anything that an individual may legally do in any state or country, and they may deal with the trust assets and conduct any business as they see fit. They also have the powers to fix and pay compensation of all officers, employees, or agents in their discretion, and to pay themselves such compensation for their services as may be determined by a majority of the board trustees. The trust instrument further provides that a, quote, minute of resolutions, unquote, of the trustees authorizing what they determine to do or have done shall be evidence that such an act is within their power. It also provides that the trustees' authority is similar to that of the executor of an estate, wherein the testator directs that the executor is to handle the estate in the manner he thinks best, limited by the terms of the instrument and without the necessity to resort to the court for permission or approval of any transaction. The grantor is designated as the executive manager of the family estate and his spouse as the secretary. As such, they are entitled to receive consult fees from the family estate for services performed for the family estate. The trust instrument provides that C and his family may continue to live in the personal residence that C transferred into the family estate, purportedly because it is for the convenience of the family estate in its capacity as C's employer. In addition, the family estate will supply the living costs and provide health care for the grantor and his family. The trust instrument further provides that the family estate shall continue for 20 years unless the trustees, by unanimous vote, agree to terminate the family estate on an earlier date. Section 61A of the Internal Revenue Code of 1954 provides, in part, that gross income means all income from whatever source derived unless excluded by law. Gross income includes income realized in any form, whether in money, property, or services. It is the first principle of income taxation that income must be taxed to him who earns it. Commissioner versus Culbertson, 337 U.S. 733 739 through 740 in 1949. We got 1949-2 CB5. Further, one who earns income cannot avoid taxation by diverting it to another entity, since anticipatory assignment of income is ineffective as a means of avoiding tax liability. United States versus Bays, 410 US 441 and 449 through 450, 1973. So 1973-1 CB 325. In the case of Lewis versus Earl, 281 US 111 in 1930, the taxpayer entered into a contract with his wife under which all property, including salaries, fees, etc., thereafter acquired by either, was to be received and owned by both parties and joint tenants. In holding that all of the taxpayer's salary and fees were attributable to him for tax purposes, the court stated that 114 through 115, quote, there is no doubt that the statute could tax salaries to those who earned them and provide that the tax could not be escaped by anticipatory arrangements and contracts, however skillfully devised to prevent the salary, when paid, from vesting even for a second in the man who earned it. That seems to us the import of the statute before us, and we think that no distinction can be taken according to the motives leading to the arrangement by which the fruits are attributed to a different tree from that on which they grow. Unquote. Oh my goodness. Regardless of whether an assignment of income is an irrevocable assignment, and regardless of whether the income is assigned for a substantial period of time, the true earner of the income realizes economic gain from the disposition of such income and is taxable on it. Galt versus Commissioner, 216 F 2D 41, 7th Circuit, 1954. In resolving the question of who earns the income, the court will look to who has actual control over the earning of the income, rather than who has apparent control over the income. American Savings Bank, 57 TC 828, 1971. Didn't he say not to use the word income? Because it's not, wait, what were the words Howard said not to use? One was like accountant or something like that. Abby. He said not to use accounting.
I was audit, but it might have been accounting. Auditor. And
okay. Because I know that they can tax income, but when they can't tax your labor.
Yeah, it was we were supposed to use revenue, not income.
Yeah, okay. What happened to everybody else?
Yeah, we're a small group.
Yeah, Joe was here and Mr. C was here.
You put everybody to sleep by your yawning.
I'm yawning so much. Okay. So similarly, in Revenue Ruling 55-2, 1955-1, CB 211, the Internal Revenue Service held that unpaid accounts receivable, which represent compensation for personal services which represent compensation for personal services and which were transferred by a taxpayer to an irrevocable trust for the benefit of his minor child were, upon collection, taxable to the taxpayer grantor and not to the trust. It is evident from the foregoing that one who transfers his future earned income by an anticipatory assignment realizes income quite as much as if he had collected the income and paid it over to the object of his bounty. It is of no consequence that such income has been assigned to a trust. C, Commer versus Davis, 107F, blah, blah, blah. Okay, that's just a bunch of court mumbo jumbo, which you can read in the book. With respect to the services performed for X corporation, the legal relationship of employer and employee continues to exist between X corporation and C. It is C, not the trust, who earns the income as an employee of X corporation. The family estate merely has the right to receive C's earnings, reduced by amounts withheld by X corporation. Accordingly, any income from services performed by C for the X corporation will be income to C and not income to the family estate. The question of who is taxable on the income from the securities and rental property conveyed to the family estate is decided under subpart E of the code, sections 671 through 678. These sections of the code provide generally that the grantor is taxable on the income of a trust over which he has retained certain powers or rights that give him substantial dominion and control over the trust. Section 671 of the code provides, in part, that where it is specified in subpart E that the grantor or another person shall be treated as the owner of any portion of a trust, there shall then be included in computing the taxable income and credits of the grantor or the other person those items of income, deductions, and credits against tax of the trust which are attributable to that portion of the trust to the extent that such items would be taken into account under Chapter 1 in computing taxable income or credits against the tax of an individual. Oh, Lord. IRS codes are just a nightmare. Section 674A of the code provides that the grantor shall be treated as the owner of any portion of a trust in respect of which the beneficial enjoyment of the corpus or the income therefrom is subject to a power of disposition, exercisable by the grantor or a non-adverse party, or both, without the approval or consent of any adverse party. Section 672A of the code provides, in part, that for purposes of subpart E, the term adverse party means any person having a substantial beneficial interest in the trust, which would be adversely affected by the exercise or non-exercise of the power which he possesses respecting the trust. Section 672B provides that for purposes of subpart E, the term non-adverse party means any person who is not an adverse party. Pursuant to Section 1.672A-1A of the Income Tax Regulations, a trustee is not an adverse party merely because of his interest as trustee. It's funny, we were just talking about this on Pastor's channel earlier today, about adverse parties. The question of whether a particular interest is adverse or non-adverse is essentially one of fact, which must be determined by considering in each case the particular interest created by the governing instrument. Floyd G. Paxton, 57TC 627 631 of 1972. In the instant situation, the third-party trustee who has no beneficial interest in the family estate is not an adverse party. The third party. Yeah, correct. That's right, because you have to have a majority of the interest to be, and not be related to the grantor to be considered an adverse party. The grantor's wife, as trustee, has no direct beneficial interest in the family estate and therefore is also a non-adverse party. The trust instrument specifies that affirmative action, except for early termination of the trust, may only be had upon a majority vote of the trustees. Thus, C, as grantor, could receive beneficial enjoyment from the family estate by the action of himself and either of the other trustees. Right? Thus, C, as grantor, could receive beneficial enjoyment from the family estate by the action of himself and either of the other trustees. Okay, therefore C is considered to be the owner of the trust under section 674 of the code. Section 676A of the code provides in part that the grantor shall be treated as the owner of any portion of a trust, where at any time the power to revest in the grantor title to such portion is exercisable by the grantor or a non-adverse party, or both. Pursuant to section 1.676A-1 of the regulations, if the title to a portion of the trust will revest in the grantor upon the exercise of a power by the grantor or a non-adverse party, or both, the grantor is treated as the owner of that portion, regardless of whether the power is a power to revoke, to terminate, to alter or amend, or to appoint. The trust instrument provides that the family estate will continue for a period of 20 years. However, the trustees can, by unanimous vote, terminate the family estate at an earlier date. If and when this occurs, the corpus and income of the family estate is to be distributed to the holders of units of beneficial interest. Since the other two trustees are non-adverse parties, the grantor could vote with either or both of them to vest title in himself. Therefore, since the grantor is the only holder of units of beneficial interest in the family estate, he may be treated as the owner of the entire trust under section 676 of the code. So wait a second. None of his trustees had any beneficial interest in the trust? Is that what they're saying? Well, no, duh. Yeah, that's a bad trust.
Well, do they have to have beneficial interest, or could they be a paid trustee?
No, to be an adverse party, you have to have beneficial interest.
Oh, but were they adverse? And I'm sorry, I didn't. I just popped in. So
yeah, they're saying they're all non-adverse parties.
Non-adverse.
Yeah, so since the other two trustees are non-adverse parties, the grantor could vote with either or both of them to vest title in himself. So I believe that's what it was saying, is like the grantor made himself a trustee, and it looks like he also made himself the beneficiary too, and had his wife and some other family member be a trustee with him, but he's the only one with the he's the only one that had been distributed holders of units of beneficial interest.
But I thought I heard you say something about something being reinvested into the trust.
No, okay, so let me read this part. The trust instrument provides that the family estate will continue for a period of 20 years. However, the trustees can, by unanimous vote, terminate the family estate at an earlier date. Yeah, we went over that. If and when this occurs, the corpus and income of the family estate is to be distributed to the holders of units of beneficial interest. Since the other two trustees are non-adverse parties, the grantor could vote with either or both of them to vest title in himself. Therefore, since the grantor is the only holder of units of beneficial interest in the family estate, he may be treated as the owner of the entire trust under section 676 of the code. So
is that a grantor's trust?
yeah, I'm assuming, like, because I think these are examples of what not to do, like how not to set up a trust. And why the IRS was able to come in and slaughter the trust, like just rip them a new one. Because it says, regardless of whether an assignment of income is an irrevocable assignment, and regardless of whether the income is assigned for a substantial period of time, the true earner of the income realizes economic gain from the disposition of such income and is taxable on it. So what he was trying to do is C, who is the grantor, who created the trust and made his family members trustees without any beneficial interest in it. He works for company X corporation, right? And he wanted X corporation to pay the trust. The corporation's like, heck no, I'm not doing that. I'm paying you. So then C went and he took his paycheck and gave it to the trust. But that's income he's putting into the trust. It's still taxable. And I think that's what he was trying to get around, because he's like, no, it's going to the trust. It can't be taxable. And he's like, no, it was going to you. You just put income into the trust, but you still need to be taxed on that because it's income. And so if it went into the trust, then it wouldn't be taxed. But it went first to him, and then he put it in the trust, and then he tried to redistribute it back to him through payments. Like, I'm going to pay you such and such money for being a trustee. I think that's
called
what
laundering. I think that isn't that called laundering money?
Yeah, exactly. But he's doing it. See, the trust of the big corporations like, Bill Gates and Amazon, all this kind of stuff, they're laundering too, but they're doing it legally. And this is something that we were talking about on his chat today, was that what they do is they will make a managing trust, right? That kind of is the umbrella that, and then they build all these other mini trusts under it, and they will create another corporation. So they'll use the money from the main trust to create another business trust. And then if you keep creating all these businesses, then you can do business between the trusts. The trusts can do business with each other and keep the money in the family. This guy is not creating another trust to do business with. He's saying, oh, I have an outside company that I'm getting money from that I want to put into the trust, but that I want to launder it back to me. So, I kind of want to whitewash it so the IRS doesn't see it. But you can't do that. He could take that money and create another business trust, and then the main trust can do business with the lower trust. And it's kind of like the guy in volume 1 where they advised him, okay, do a trust for your ex-wives, do a trust for your kids' college funds, and your child, alimony, not alimony, sorry, that goes to the ex-wives. The child support. Yeah. And then do one for pre-assets for the man, do one for pre-assets for the soon-to-be wife, the new wife. And then you can use those trusts as like a business trust. So if his company, right, because remember he needed like, what was it, Xerox machines or something like that. So he had his children's trust buy those machines, and then he leased out those machines via the kids' trust. So he would put money into there, and then they would lease him the machines for parts, so he could build up his own machine and sell that. And so they were having him set up multiple trusts to do business with each other. And that's the way to do it. This guy, he's not doing that. He's just thinking, okay, I'm working for an outside company. I'm going to get money from them. I'm going to shove it in the trust, and then I'm going to regurgitate it back to me. And that way the IRS can't tax me, but they can. They absolutely can, because once it converts into income, then you are going to be taxed on that. Crap, what page was I on? Oh, no. Oh, here we are. Okay. All right. We're on page 144. Okay, back to section 677A of the code provides in part that the grantor shall be treated as the owner of any portion of a trust whose income without the approval or consent of any adverse party is, or in the discretion of the grantor or a non-adverse party or both, may be distributed to or accumulated for future distribution to the grantor or the grantor's spouse. Okay. Section 1.677A-1D of the regulations provides in part that under section 677, a grantor is in general treated as the owner of a portion of a trust whose income is, or in the discretion of the grantor or a non-adverse party or both, may be applied in discharge of a legal obligation of the grantor or his spouse in the case of property transferred in trust by the grantor after October 9th, 1969. Yeah, I'm not exactly sure what that means or how it relates to this, but let's keep reading. Section 677B of the code provides in part that the income of a trust shall not be considered taxable to the grantor under section 677A or any other provision of Chapter 1 merely because such income in the discretion of another person, the trustee or the grantor acting as trustee or co-trustee, may be applied or distributed for the support and maintenance of a beneficiary other than the grantor's spouse, whom the grantor is legally obligated to support or maintain, except to the extent such income is so applied or distributed. Okay, so this one is saying that the income generated from the trust, just because the grantor put all that corpus in there into the trust, it's not once it's in the trust, then it's owned by the trust. So the grantor can't be taxed on that corpus because it's now owned by the trust. Either because of such income in the discretion of another person, the trustee, grantor acting as trust, may be applied or distributed for the support and maintenance. May be applied or distributed by the support and maintenance, other than the grantor's spouse, whom the grantor is legally obligated to support. Again, I think what it's saying here is it may be applied or distributed for the support and maintenance of a beneficiary. So a trust can give money to a beneficiary, but the beneficiary is going to be taxed on that. But the whole point of having the trust pay out is so that the trust itself isn't taxed at a much higher amount. So if you give out little disbursements here and there, their tax bracket's going to be much lower. Section 1.677B-1D provides in part that the exception provided in section 677B relates solely to the satisfaction of the grantor's legal obligation to support or maintain a beneficiary. Consequently, the general rule of section 677A is applicable when in the discretion of the grantor or non-adverse parties, income of a trust is or may be applied in discharge of a grantor's obligations, other than his obligation of support and maintenance falling within section 677B. Thus, if the grantor creates a trust, the income of which may, in the discretion of a non-adverse party, be applied to the payment of the grantor's debts, such as the payment of his rent or other household expenses, he is treated as the owner of the trust regardless of whether the income is actually so applied. I swear, I think we just need to take a class on IRS codes. In the case of Lewis W. Hill, 33 BTA 891, 1936, AFID 88F2D 941, 8th Circuit, 1937, the court held that the grantor was taxable on income used to support his wife and maintain the home in which the grantor and his wife resided. Okay, so the court held that the grantor was taxable on income used. Okay, so whatever money he used to support his wife and maintain the home, that was taxable. Further, it has also been held that the grantor is the owner of a trust where the income or authority of a non-adverse trustee can be applied to satisfy the grantor's debts. The grantor is the owner of a trust where the income... I think a lot of this has to do with like non-adverse trustee versus adverse trustee. Okay, see Herbert A. Loeb, 5TC. There's a bunch of numbers about circuit courts and dates and all that kind of stuff. And James L. Knight, 39 BTA, 437, 1939. Okay, so all of those are kind of it's not in the footnote, but it's a footnote to what was said above. Okay, so next is similarly, the service has held that a taxpayer who has conveyed mortgaged property in a trust and has a personal liability on the mortgage, which continues after the conveyance in trust, is taxable under a predecessor of Section 677 of the Code on the use of the trust income in discharge of the interest or principal on the mortgage. Revenue Ruling 54-516, 1954-2 CB 54. Wow, this is getting deep. Although the trust instrument of the family estate does not specifically provide that the trustees have the power to distribute income to the holder of the beneficial interest, in parentheses, the grantor, under the authority inherent in the instrument, the trustees have exercised the power to distribute income to the grantor by discharging certain of his obligations for housing and health care. Although the trust instrument for the family estate does not specifically provide the trustee have the power to distribute income to the holder. All right. Therefore, since the income of the trust has been and may be distributed to the grantor or his spouse, either without the approval or consent of any adverse party, or in the discretion of the grantor and a trustee who is a non-adverse party, C is treated as the owner of the trust under Section 677 of the Code. I'm telling you, like, it's kind of vital to have an adverse trustee in there, because it brings you into all these like nasty little codes. So, okay, this is my interpretation, and correct me if you guys have a different interpretation, but they're basically stating, because the grantor is the one who created the trust, he's a trustee, he's also a beneficiary, and he's the only one with interest in that trust, and there's no adverse trustee in there, then C is now being looked at as the owner, as the almost like the trustee. So he's responsible for everything. Where the whole thing about making a trust is that the grantor loses any responsibility. They take themselves out of it to create separation. But he didn't do that, and so he's being subject to all these codes. Is that what you guys are getting?
Good.
Okay. Accordingly, because of his dominion and control over the family estate trust, for federal income tax purposes, C will be considered the owner of the trust either under Section 674, 676, or 677 of the Code, or a combination of these, as the case may be. Therefore, as provided by Section 671, in computing his taxable income and credits, he must include those items of income, deductions, and credits to the extent such items would be taken into account in computing taxable income or credits against the tax on an individual. See also Floyd G. Paxton, 57 TC 627, 1972, in which the grantor of a trust similar to the family estate was considered to be an owner of the trust. All right, also released as TIR 1383, dated June 9, 1975. Oh, fun, more revenue rulings. Revenue ruling 54-516. It's 1954-2 CB 54, section 61. A transferred certain real estate to a trust, naming himself as trustee and his children as beneficiaries. Under the terms of the trust instrument, I'm assuming instrument means the same thing as indenture. The trust is to continue until the youngest of the children or the survivor of them becomes 21 years of age. The income of the trust, with certain exceptions, is to be accumulated in the trust during the term of its existence. The grantor has not retained a revisionary interest in the trust corpus or income therefrom, nor a power to control the beneficial enjoyment of such corpus or income. Upon termination of the trust, the corpus and accumulated income thereon will be distributed to the beneficiaries in equal shares. Held, the income of the trust is taxable to the trust and not the grantor trustee. However, any income of the trust distributed and applied for the support or maintenance of a beneficiary whom the grantor is legally obligated to support or maintain will be taxable to him. What? That's crazy. So, say he does this trust for his kids, and his kids are, like 9, 10, 12, where he's still financially responsible for them. He's going to be taxed. So, full text, Revenue Ruling 54-516. Advice is requested whether the income of a tax is taxable to the grantor under the following circumstances. A transferred to a trust for the benefit of B and C, his children, certain real estate against which there is a mortgage. The trust instrument names A as donor and trustee and states that the trust shall be deemed a gift in equal shares to B and C. Wait. Oh, I see. Sorry. A transferred. Okay, not A transferred. Okay, A is a person. A transferred to a trust for the benefit of B and C, his children. Okay, so B and C are his kids. A is the grantor. And he transferred certain real estate where he's still paying a mortgage on. The trust instrument names A as donor and trustee. And states that the trust shall be deemed a gift in equal shares to B and C, his kids. The instrument provides that the trustee shall receive and add to the corpus of a trust any property which at any time may be transferred, assigned, delivered, bequeathed, or devised to the trustee for the trust by the donor or by any other person, or which may otherwise be acquired by him, or which he may receive under any insurance policies made payable to him by the donor or any other person. Okay. I think what he's saying so far is that until the kids get a little older, like he's just trying to build the trust at this point. And so he's going to have some of that money coming back to him to pay off like the mortgage and stuff like that, I guess. Instead of maybe what he didn't do was have the trust pay off the mortgage, but now he's trying to put money in the trust so he can take money out of the trust so he can make payments instead of having the trust to make the payment. I don't know. That's what I'm getting thus far. Okay, the trust instrument provides further that the income from the real estate shall be used first to pay the necessary expenses of the trustee in the administration of the trust. taxes on the real estate, interest and principal on the mortgage, and expenses of maintaining the property. Okay, so wait, maybe he didn't. The trust instrument provides further that the income from the real estate shall, okay, so he did write that in the indenture, that the trust pays the mortgage, property, taxes, and necessary expenses of the trustee in the administration of the trust. Okay, the balance of the income from all trust properties shall be accumulated and added to the principal of the trust. Notwithstanding the provisions directing the accumulation of income in the trust, the trustee has the power, when he deems that the income from the trust is sufficient to effectuate the purpose of the trust and to meet its current obligations, to pay any or all of the income of the trust, whether accumulated from prior years or received during the current year, in a duly appointed guardian for either or both of the beneficiaries of the trust. Should the trustee make such a distribution of income, such distributed income shall be the property of the beneficiary outright, under the control of his guardian, which A is the guardian, because the beneficiaries are his kids. The trust will continue until C, the youngest of the children, becomes 21 years of age. Should either beneficiary die before C becomes 21 years of age, the trust will nevertheless continue until the survivor of the beneficiaries becomes 21 years of age. And in such event, the surviving beneficiary, upon reaching the age of 21 years, shall receive the entire corpus and accumulated income of the trust. Should both beneficiaries die before the trust is terminated, the trustee shall convey the entire trust estate to the lawful heirs of the beneficiary, who dies last. Broad powers of management are granted to the trustee. However, the trustee may not make loans of trust money to himself, nor convey trust assets to himself. In no event shall any of the trust income ever be used to pay the legal obligations of the donor trustee. The donor has no right or power to revoke the trust, and he may amend the trust instrument only for the purpose of granting additional powers to the trustee. Such additional powers, however, may not extend to include the power to grant any right or benefit to the donor. Okay, what is a donor? Donor's a new word, isn't it? Donor would be the person who puts corpus, the exchanger, right? Would that be kind of the same? Exchanger, donor? Anybody know?
I'm a little confused.
All right. Okay, four main components in a trust. Grantor, the person who creates the trust, also known as donor, settler, or trustor. So it's the grantor. Yeah.
They keep changing the names then, or the titles.
Yeah, well, yeah, kind of like one and the same. I'm finding a lot of these use like different names. Okay, here's understanding revocable trust. A trust is a legal arrangement through which one person holds legal title to property for another person. As the creator of a revocable trust, you are called the grantor or the donor. Okay, so grantor and donor are interchangeable. Because I think it's the same thing as an exchanger, because that's the person who's putting the corpus into the trust to get the trust going. Such additional powers, however, may not extend to include the power to grant any right or benefit to the donor, so the grantor. Okay. So far, I mean, I don't see anything. I mean, does he have a trustee? Is there they don't tell us if he has an adverse trustee in this. Or is he saying that he's trustee, donor, and grantor, and he's the only trustee? Because I'm not seeing anywhere where he says anything about, oh, wait, yes, okay. So the trust instrument names A as donor and trustee. There we go. Boom. There's where he screwed up. There's no separation. Bequeathed or devised to the trustee for the trust by the donor. Okay, so yeah, I think that's where his problem is. He's trying to control the entire trust without any outside trustees. Like it's just him. So let's see what the IRS has to say. Okay, you got section 39.22A-21 of regulations 118 provides that income of a trust is taxable to the grantor under section 22A of the Internal Revenue Code of 1939, where 1, the grantor has a revisionary interest in the corpus, because he's the only trustee, and the grantor, or the income therefrom, which will or may reasonably be expected to take effect in possession or enjoyment within a relatively short term of years. See section 39.22A-21 of regulations 118. Or 2, the beneficial enjoyment of the corpus or the income therefrom is subject to a power of disposition other than certain expected powers or accepted powers, exercisable by the grantor or another person lacking a substantial adverse interest. See, he's lacking substantial adverse interest in such disposition. Or both. Or 3, the corpus or the income therefrom is subject to administrative control, exercisable primarily for the benefit of the grantor. Where any one or more of the above conditions is present, the income of such trust is taxable to the grantor. Okay, so there's 3 problems with his trust. 1, he's the grantor and the trustee, and there's nobody else there working the trust. And then 2, he's doing this trust for his kids who are underage. So he's still legally responsible for them. So he needed to have a beneficiary in there that was of legal age and could get disbursements. So that was his second issue that I'm seeing so far. Under the trust agreement, the grantor has not retained a revisionary interest in the trust corpus or income within the meaning of section 39.22A-21 of Regulation 118. The beneficial enjoyment of the trust corpus or income is not subject to a power of disposition by the grantor or other person, Although broad powers of administration are granted to the grantor trustee, the trust instrument specifically provides that neither the corpus nor the income of the trust is subject to administrative control exercisable primarily for the benefit of the grantor. Accordingly, it is held that the income of the trust is taxable to the trust and not to the grantor. However, if any of the income of the trust is used for the support of either of the beneficiaries during the period that the grantor is legally obligated to support such beneficiaries, the income so used will be taxable to the grantor under Section 167 of the Code. Furthermore, if the grantor remains liable in any capacity other than as trustee for the mortgage on the real estate transferred to the trust, any income of the trust which is used to pay principal or interest on such mortgage will be taxable to him. And then see Section 39.167-2 of Regulation 118. All right, so do you guys get that? What just happened? Crap, we have another one of these stupid things. Oh, okay, this is the last one. All right, Revenue Ruling 55-2, 1955-1, CB 211, Section 61. Unpaid accounts receivable which represent compensation for personal services transferred by a taxpayer to an irrevocable trust for the benefit of his minor child are upon collection taxable to the taxpayer grantor and not to the trust. All right, let me read that one more time. Unpaid accounts receivable which represent compensation for personal services transferred by a taxpayer to an irrevocable trust for the benefit of his minor child. Okay. Full text, Revenue Ruling 55-2. Advice has been requested whether accounts receivable transferred to an irrevocable trust created for the benefit of a taxpayer's minor child are upon collection taxable to the grantor or to the trust. Okay. A taxpayer whose principal source of income arises from his professional practice as a surgeon created an irrevocable trust for a minor child to ensure to him adequate educational and other opportunities and transferred to the trust annual gifts of selected accounts receivable. The trust agreement provides that the funds received upon collection of the accounts receivable and the income therefrom shall be accumulated until the beneficiary reaches the age of 21 years or enters college, whichever may occur first. Whereupon the principal and income are to be paid in regular installments. A bank is designated to act as trustee, and the taxpayer retains none of the rights of administration or control. Okay, so you got the grantor who's separate, then the grantor made the bank the trustee. So that creates separation. Section 39.22A-1 of Regulation 118 provides that gross income includes in general compensation for personal and professional services, business income, profits from sales of and dealings in property, interest, rent, dividends, and gains profits, and income derived from any source whatever unless exempt from tax by law. Payments for personal services are always due primarily to the person rendering the services. He remains the owner of the right or title from which the income springs. C.A.D. Sanger et al. Versus Commissioner. 69 Fed 2D 631. Edward G. Luce et al. Versus Burnett. 55 Fed 2D 751. When such earnings are assigned, the assignee takes as representative of the assigner, and the earnings continue to be taxable to him. In Halving versus Paul R.G. Horst, 311 U.S. 112, CT-D 1472, CB 1940-2, 206, the Supreme Court said, quote, "The power to dispose of income is the equivalent of ownership of it. The exercise of that power to procure the payment of income to another is the enjoyment and hence the realization of the income by him." See also Lucas versus Guy C. Earl, 281 U.S. 111, and Halving versus Gerald E. Eubank, 311 U.S. 122, Count D, 1473, CB 1940-2, 209. Accordingly, it is held that unpaid accounts receivable, which represent compensation for personal services transferred by a taxpayer to an irrevocable trust for the benefit of his minor child, are, upon collection, taxable to the taxpayer grantor and not the trust. Whatever may be clear after reading this is likely to become more obvious as you would through the various explanations and look through the sample formats. Okay, so I'm just wondering, was he thinking, I'm just going to take a chunk out of my pay from being a doctor, throw it into the trust, and then not report that? Because that seems kind of not smart. Okay. All right, I'm going to try to read this one a little faster. And we may be showing the last, 7 pages of this because it's in a diagram type situation. So, okay, we're at chapter 14 now. And then we got them. The IRS does not win all the time, as we saw with Mr. Betts in Volume 1. Here are some other stories to ponder, along with a partial list of trust cases for those who want to delve into the details. Creditors failed. Mr. Jack E. Cisner set up a trust for his children, and as time passed, the IRS asserted he owed back taxes. There was no proof as he set up his trust more than 18 months before his creditor problems began. The courts ruled that a trust settled in good faith by the grantor for the benefit of his children cannot be penetrated and assets seized to pay the alleged tax debts of the grantor on the ground the trust was established to defraud the grantor's creditors, where the conveyance of the assets of the grantor did not leave him insolvent, and where it was done prior to him having knowledge that at some future date he may allegedly owe taxes to other debts. Dust off the past. So basically, he set up this trust for his kids, and then later on he ends up getting into trouble with debts, and the IRS is trying to come after him saying, we want access to that trust money because he did it to defraud us. And the court's like, yeah, I don't think so. He set this up way before his crediting issues. And so, yeah, you're not getting it. So dust off the past. Way back in 1940, the irrevocable tax laws were not so well defined. In one of the older cases about irrevocable trust, we find the grantor is not taxable. A serious look at this court case suggests that in today's legal setting, this trust might have been broken. Mr. Branch, Commissioner of Internal Revenue Service versus Branch, United States Court of Appeals for the First Circuit. Mr. Branch created a trust with securities held as collateral for a promissory note. He also became a trustee and appointed 2 more trustees. He gave all the income to his wife. The Internal Revenue Commissioner objected based on the fact that the corpus reverted to Mr. Branch when Mrs. Branch passed away. The commissioner also argued that Mr. Branch had the power to revoke the trust. All he had to do was to default in paying his notes, and the bank would then foreclose on the securities, which made up the trust estate, and apply the same to satisfy his private debt. The Court of Appeals rejected the commissioner's argument because if Mr. Branch did default on the notes, he was still obligated to pay back the trust estate for any losses incurred. Further, the court stated that because the grantor's agreement to clear the trust estate, the pledges would be obligated on principles of marshalling to resort first to the securities not included in the trust estate. For aught that appears in the records, this recourse might itself be enough to satisfy the notes, without any harm of the trust estate. If not, there is still the grantor's personal debt to pay back the estate. Because of today's standards for an irrevocable trust, there are several questionable points. Point 1. Because of joint and community property rules, the wife receiving the income would be considered the same as both the husband and wife receiving the income. If Mr. and Mrs. Branch were in a community property state, she would need to surrender her rights to the property to become a beneficiary. Point 2. Mrs. Branch, as the beneficiary, holds the power to revoke the trust as well as any part or parts of the trust estate, which could make this a revocable trust. Point 3. Mr. Branch, as grantor and trustee, had sole investment powers without limits of normal investment procedures. In later cases, it has been determined that this unbridled discretion voids an irrevocable trust. Point 4. Mr. Branch, as grantor, reserved the power to replace a trustee, which, although the trust was not revocable, the trustees could be fired by the grantor or the beneficiary. In today's legal climate, this could qualify the trust as revocable. There are some other points about this trust that make it most interesting. Although the amount of the corpus is not known, we do know the promissory note was for $400,000. Therefore, we can assume that Mr. Branch was wealthy, as the court expressed no concern that he could repay the trust if he defaulted on the loan. Further, Mr. Branch never took any of the money for himself. There is always the possibility that Mr. Branch won his argument because of assets that he did control, and it just could be that a person with less influence would have lost the argument. As mentioned in Volume 1, the IRC contains information about common law trusts because they were used before the Federal Reserve created the taxation we now have. Some of these cases are old, some of them more current. When reading current court cases about trust and taxation, many of these sites are referenced. Favorable court decisions. Here is a list of court cases and related information favorable to trusts. We share our excerpts from compiled collections. Try this again. Okay. So, whoops, that didn't work. Okay, so number 1, head note 5, where husband created a trust for benefit of wife and child for the purpose of ensuring that a considerable part of income should go to the wife and the wife as well as husband, and the wife as well as husband was a trustee. Wife had a substantial adverse interest in disposition of corpus and income within Revenue Act of 1934, Title 166, Paragraph 166, and hence husband was not taxable on trust income paid to wife. That's Phillips versus Commission of Internal Revenue, 1943. We've got income from a long-term irrevocable trust of which petitioner, Small, was grantor and trustee, and over which the trustee had broad power of management, held not taxable to petitioner. And that was in 1941. And these, I would probably suggest taking a couple of these and going and researching them. The income of a trust was not taxable to grantor under Statute Revenue Acts 1934, 1936, Title 166, governing taxation to grantor of income from revocable trust merely because grantor reserved the right to receive principal upon death of his wife if he should then be living, since while power to revest or revoke may in economic fact be the equivalent of revision or reversion, Congress confined the statute to trust where there was power to revest and did not extend it to trusts which might revert to grantor. That's 1942. A trust is not dependent upon statutory law. A common law trust is not subject to legislative control. The trust relationship comes under the realm of equity based upon the common law and is not subject to legislative restrictions as are corporations and other organizations created by legislative authority. Oh, that 1911. Where the declaration gives the trustees full control in the management of the business of the trust and the trust certificate holders are not associated in carrying on the business and have no control over the trustees, then there is no liability as partners. 1926. A trust is not illegal if formed for the express purpose of avoiding taxation. Wait, a trust is not illegal if formed. Oh, okay. I see what they're saying. That was done in 1920, that ruling. It is a familiar rule that equity will not permit a trust to lapse for lack of trustees. It is also a familiar rule that a court of equity has power to remove trustees upon a proper showing of fraud or unfitness on their part. 1922, Burnett versus Smith. Even bad bargains in a genuine business transaction are held not to result in taxable gifts. Where value of a stock was in excess of the consideration, the transfers were made in the ordinary course of business and are not subject to gift tax. Attorney Leon Jaworski, later special prosecutor in Watergate, argued this case against the IRS. Estate of Anderson versus Commissioner of Internal Revenue. The bank alleged that Kaminsky owed them $20,000 when Kaminsky had no personal assets to seize. After the bank obtained judgment, they tried to seize the assets of an equity pure trust Mr. Kaminsky had set up a few years before. The bank's actions failed as they were unable to penetrate the trust. United States National Bank of Omaha versus Andrew Kaminsky, civil action number 77. That was in 1980, a little more recent. Okay. Income was not taxable to donor where trust could not be revoked, altered, or amended for his benefit without the consent of the primary beneficiary or a person having a substantial interest in the disposition of the corpus or the income. Bradley versus IRS, 1943. A provision permitting the grantor as income beneficiary to call for corpus if needed to make the total distribution for any year $10,000 was lost to that beneficiary when he assigned all of his rights in the trust income to his wife. 1949. Herbert versus IRS. Common law trust is not a corporation. The definition of corporation is, quote, the right to be a corporation and to exercise corporate powers is derived from the state. The power which creates has the power to destroy. The state has the right to limit the period of existence of its creature, the corporation, to provide conditions precedent or subsequent by laws pre-existing at the time of its creation, or by laws subsequently passed to destroy its existence, for such reasons as may seem to the legislature sufficient. City of New York versus Bryan. That was 1909. That's an interesting saying. Because common law is not a corporation, because he who creates it has the power to destroy. And if you create a trust, the state didn't create that trust, so they can't destroy that trust. And if a state did create the trust, then they would have the power to do that, but they don't. The business trust is not subject to the corporate tax on dividends. This is in Internal Revenue Code 651, deductions for trusts distributing current income only. 652, inclusion of amount in gross income of beneficiaries of trusts distributing current income only. 1491, imposition of tax. The form of a contract is the considered and chosen method of expressing the substance of contractual agreement between parties, and the dignity of contractual right cannot be judicially set aside simply because a tax benefit results either by design or accident. Edward versus IRS, 1969. Supreme Court has from earliest times recognized the private trust as a valid legal relation. Reeves versus Powell, 1924. Trust property cannot be held under attachment nor sold upon execution for the trustee's personal debt. Mayo versus Moritz, 1890. Wow, okay. Where taxpayer reserved no powers or rights, either as grantor or trustee, by which he could revert any of the principal or income of the trust, the income thereof is not taxable to him. Moore versus IRS, 1944. Where trust established by grantor for his children, in addition to granting extensive powers of control and management, authorized grantor to make such changes as he saw fit in management of trust estate for the best interests of his children, but power to revoke or retake any of the corpus or income was specifically denied to grantor. And on termination of trust, both corpus and income were to be distributed to children named or their issue or offspring. Trust income was not taxable to grantor under statute defining gross income or under statutes making income of a revocable trust or income for a grantor's benefit taxable to grantor. Jones versus Norris, 1941. Certificates of a trust are personal property and convey no interest in the trust's property. Okay, drink some water. Parker versus Mona Marie Trust. Grantor could never obtain any of capital gains of trust created for benefit of his wife and mother except upon happening of a remote, uncertain, and improbable contingency. The capital gains of trusts were not taxable against grantor. Okay. Commission of Internal Revenue versus Betts, 1941. Where grantor of trust has stripped himself of all command over income for an infinite period, and under terms of trust instrument will probably never regain beneficial ownership of the corpus, the trust income should not be treated as grantor's income under income tax statute merely because grantor is trustee with broad power of management. IRS versus Branch, 1940. Where trust established by grantor for his children, in addition to granting extensive powers of control and management, authorized grantor to make such changes as he saw fit in management of trust estate for the best interests of children, but power to revoke or retake any of the corpus or income was specifically denied to grantor, and on termination of trust, both corpus and income were to be distributed to children named on their issue or their issue. The trust income was not taxable to grantor under statute defining gross income or under statutes making income of a revocable trust or income of grantor's benefit taxable to grantor. Jones versus Norris, 1941. Under trusts created in Illinois for the benefit of grantor's children, authorizing grantor's wife and brother, who, with the grantor, were trustees to change during grantor's life the trusts in any respect, the grantor was taxable as direct beneficiary of income, where under Illinois law, it would be possible for trustees to accumulate the income for or to distribute it to the grantor directly. Note, grantor is taxed on income as beneficiary. Helvering versus Stewart, 1942. A lot of this stuff's happening in the 40s. Where trustees had primary primary responsibility to pay indebtedness incurred in purchase of trust corpus, and settlor had only contingent liability to pay if trustees should fail to do so, and indebtedness was incurred contemporaneously with establishment of trusts and solely for a combination of trust and settlor, had no rights to trust income. The trust income used to pay indebtedness was not used to pay personal indebtedness of settlors, and hence was not taxable to settlors. Edwards versus Greenwald, 1954. Now, because the courts have repeatedly ruled that trusts are lawful, separate, profit-making business organizations, any disallowance of the fiduciary fee paid to establish this trust is in error. The fiduciary fee is a trust-deductible business expense. That's IRC Section 212. Fair market value is determined by property received by taxpayer and not the FMV of property transferred by taxpayer to the trust. Commissioner versus Marshman, 1960. Certificates in exchange are not taxable until a realized gain has occurred. Burnett versus Logan, 1931. Wait, how many more of these we got? Just one. Okay, of course, a corporation may prefer its creditors except in a general deed of assignment, provided it acts in good faith and with no fraudulent intent. But a trustee who holds for their common benefit cannot discriminate between them. Ashworth versus Hagen Estates, 1935. The power to tax is subject to the 5th and 14th Amendments due process provisions. Congress can deprive no one of due process. Beeland Wholesale Company versus Kaufman, 1937. Community interest may be dissolved by either spouse by knowingly conveying interest to the other. In regards to Baldwin Estates in 1937. Certificates are not chattels, but are evidences of intangible rights. Goodhue versus State St. Trust Company. Where taxpayer, as beneficiary of trust set up in divorce decree, could exercise her own judgment as to amount of trust income necessary for suitable support of the children, taxpayer has a substantial adverse interest to the husband as grantor, and income from trust was taxable to beneficiary and not to grantor. Ketchum versus IRS, 1944. Court cases about trusts to be read by the inquiring attorney. And that's a bunch over there. The IRS recognizes that there can be such a thing as a transaction where property changes hands without any taxable event. The term non-renegotiation transaction means any disposition of property in a transaction in which gain or loss is not recognized in whole or in part for purposes of Subtitle A. IRC 7701, 145, non-recognition transaction. Last one is a taxpayer exchanges stocks into a trust in exchange for a promise of future income, where the future income could not be accurately determined at the time of the exchange. That's Stern versus the IRS, 1984. Okay. And that is all. Anybody have anything to discuss about what we just read? A lot of boring stuff tonight. Anything that has to do with the IRS is boring. What was that, Justin?
I just got here. I forgot. I was late again. I'm sorry.
Oh, you could have said you were here for the last half. I wouldn't have even noticed, because when I'm reading, I don't really notice who's on unless I stop to ask questions. Yeah, you didn't miss a whole lot. Just kind of telling us how not to set up a trust.
Normally, the boring parts are the most important parts, though.
I know. Because really, it's all about, most people set up trusts to avoid taxation, which is funny that one of the things that they said was it doesn't make a trust illegal if they create it to avoid taxes.
I thought it was created pretty much to protect property.
Yeah. So the freaking government can't come in and steal it, just like in the old days where the king would come in and steal it while you were off at war for the king.
Exactly.
Yeah, a trust is not illegal if formed for the express purpose of avoiding taxation. Boom. We know the government's trying to come in and take everything. Greedy little hands. They've already taken everything. Now they want control over everything.
It's because we're not managing them. I mean, it sucks, but it's our own damn fault because we are not governing them, so they are governing us.
No, I get it, but evil is evil. Evil will always try to control you. And
I definitely agree with that.
Every year they get better and better at the deception. So it's all about reading, like being able to read the deception and being aware of it. Because if you're on guard all the time concerning them, then a lot of their deception is not going to get by you because you're going to be ready. However, they're still, they play dirty, and
they play dirty. Like what was it? It was just Friday morning. I sent out a FOIA through the email to the police department and to our record keeper at the beach administration. And then I was going to go and take the paper copy up there just to get them to stamp it to confirm they received it. And nobody would talk to me. Like, everybody ran out of the room at the police station. Nobody was even in there. And then so I walked over to the other lady's office, the record keeper, and they said she won't be back in until next Wednesday. I said, all right, I'll see you Wednesday.
Exactly. I mean, I don't know. It's inevitable. I mean, we're going to get screwed at some point because they have a whole team of people and we just have kind of ourselves. So it's definitely David against Goliath type situation, but you still have stones in your pocket to throw at them to combat.
I truly believe it all comes down to faith and confidence.
Yep. That's for show, for shizzle.
And I did have my GoPro on with my little chest mount and stuff, so that might have been, they don't want to be videoed, so.
Well, they have to. They're public servants. Sorry, that's in your job description.
Yeah, they don't realize that. That's not what they signed up for. They all have complexes where they just want to be in charge of something.
Yeah, well, smile for the camera is what I say. All right, I'm
Yeah,
gonna
it's been,
go. Oh, what? Say?
no, I sent in a pretty lengthy record request from where they arrested me last year on a bunch of bogus stuff.
Yeah.
So now I'm ready to throw the book at them, and they're running away from that book.
Like, that book's heavy. Take cover.